Recession. I don't think there's going to be a recession, says this gentleman. We're going to react to that one here today. That's a very interesting video because I think most people feel like we're either been in recession or we're going into recession. So react to that one here, hear what he has to say in regards to that. In the second video we're going to react to here is the Fed is close to pausing, says gentleman from JPMorgan. So I think that's interesting as well. So we'll react to both those. Hope you guys enjoy this. As always, on CPI Day, I'll have a video coming on the main channel, maybe late this afternoon or tonight, about kind of everything going on there and kind of my thoughts around that. First off, thank you everybody that supports on Patreon. If you're looking to join us on Patreon, check out the pinned comment down there. And also, tomorrow's the big day, the second buys ever in the new Patreon portfolio. What stocks will I buy? We shall see. All the Patreon folks will know. Hope you guys enjoy this as always. Appreciate you joining me. Thank you for being subscribed. Let's get into this.
You're welcome. And when do you become, maybe you are bullish on stocks here, or when do you become more so?
Well, I think the plan for 2023 is the Fed will start easing. Not easing rates, but lowering the heights of which he raises rates. So maybe 25 basis points and then the next 25 basis points. After that, Kelly, I don't expect the Fed to make any material statement that they're going to cut. But if they just pause, that will be a tremendous catalyst, especially for tech companies this year to rally. And so that's what I'm looking forward to. I think by 6 months into this year, we will start to see that.
Yeah, I think the component, I think so many people miss time and time again when they discuss this subject, right? Is a lot of people think it's going to be okay for the Fed to go to 5% or whatever and stay there for a while. But you got to understand, like, the longer the Fed keeps rates at a very, very high rate compared to anything we've been used to over the past 20, 30 years, right? The longer they do that, the more likely you're going to have a recession that follows, and a pretty significant one nonetheless, right? Because we just know, like, if you're going to have a Fed funds rate at 5% plus, it's going to mean way less activity in home buying, in cars, in manufacturing, and ultimately jobs will be lost there, and you'll just have a very kind of poor economy for quite some time until you kind of dig out of that, and it takes a while, right? And so I think that's a component that's missed, and that affects obviously corporate earnings, right? And if corporate earnings are affected, that hurts the stock market.
Troubled by increasing recession talk that we're hearing from CEOs and economists, particularly for the second half of the year?
I'm not, Tyler, because I don't think there is going to be a recession. And even if there is one, I think it will be very, very thin and very short lasting. Mm-hmm. And I think we have to look beyond that. And the most difficult thing, I think, for all investors right now is we're recovering from last year, which we all got our pants kicked. Mm-hmm. And now we have to figure out where it's headed this year. And I do think the Fed has done a very, very good job. It has been less than a year that they've been raising rates. And so by a year, I would say March of this year, we will start to really see the successful impacts of their campaign.
Hasn't the market really been rallying since October?
Well, not in my book. I mean, I've had a tough year last year. I run a concentrated portfolio.
If anybody's wondering, the market, you could go back and look at a stock chart, essentially. The market started to rally right around October 13th, and it rallied all the way into essentially the very end of November. Then the month of December, the market was horrible. The NASDAQ was down double-digit percentage. It was a very, very bad month. So far, January, we started out decent so far. So maybe January will be good. We'll have to see. But obviously, earnings are coming here. Some start tomorrow, and then obviously start to really ramp up over the next 2 or 3 weeks. That will be what really dictates how we finish out the month.
14 stocks long. I have introduced the concept of shorting stocks, which has helped things. But in my eyes, I would say we have been really, really held back, especially on the growth stocks. But we do see little hints, such as today or the past couple of days, when people are starting to actually adapt to the narrative that the Fed might actually slow down on these hikes.
Mm-hmm. Peter, not a side note, I don't know, but Zillow is one of the stocks that you're short, which is having this big ripping week on it. It got a double upgrade the other day. We spoke with that analyst, but you think it's fundamentally flawed?
I do, Kelly. And let me tell you, there's all kinds of explanations about their so-called Zestimate, which is their algorithmic approximation of how houses are worked. And hats off to them. You know, it's actually a verb now. You can say, I Zillowed my neighbor's house to get a sense of what the market valuation is. And they brag about all kinds of neural networks and artificial intelligence analysis for this. And I have to tell you, I did something extremely simple to test this. I went on the site, on the web, I Googled my own house, and do you know you can log in to your own house and change those parameters to be anything you want. For instance, if you have a 3-bedroom house, maybe you want to enlarge it to 15 bedrooms. So you can actually put false data into that database, and that goes into their Zestimate.
What? Yeah, so what? Just because you can update the information, he thinks like that's a reason to short the stock? What in the world is that gentleman talking about? In all due respect, okay? That's the most insane thing I've ever heard, and I'm not even long Zillow. It's a company I'm not interested in. Also, this short makes no sense. Do you know why that short makes no sense? This is a man that just said we're going to have no recession, but yet is short that stock. That doesn't make any sense. I can understand you being short Zillow stock or any housing stock if you felt like, hey, yeah, we're going to have a recession or we're already in recession, it's going to get worse, blah, 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 right? Because then you could say, okay, housing is going to be down for a few years, which means way less clicks, way less people using something like Zillow, way less people interested in anything real estate related, right? And coming off those high numbers, so then Zillow's just kind of in a down and out place for the next couple of years. There would be a plausible idea for shorting, but because you can update information about your home on Zillow is got to be one of the most silly things I've ever heard. But hey, man, you know, I don't know if it's his money or his client's money or whoever's money, but that's just a funny one there. Okay, nonetheless, sounds like a short position that will likely be taken with a massive loss. Next one up here, the Fed is close to pausing, says JPMorgan. All right.
Is Bill Camparelli, JPMorgan Asset Management Portfolio Manager on the Multi-Asset Solutions team. Always a mouthful. Good to see you, Bill.
Good to see you.
So why are you not convinced?
Yeah, so we're still underweight right now because the Fed last year did their quickest monetary tightening that they have ever done. They've moved by 450 before, but they've never done it that quickly. So there still remains uncertainty about what that lagged effect of policy does. However, the 60-40 portfolio, right, the multi-asset portfolio that was so painful last year. Sarah, last year was the first year since 1974 that 60-40 portfolio was down, with both stocks and bonds being down. It's so hard to manage risk in that environment.
So that you think changes, bonds
So that changes,
yeah.
right. So the bonds work. And I think one of the things that was underestimated last year was just the fact there was nowhere to hide. You couldn't manage risk unless you just said, okay, I'm going to go into cash. And nobody really thinks about that. Now, what this sets us up for now is we have the best forward-looking return on the 60-40 of 7.2% that we have had over the next decade since 2010, right? So the cost-benefit analysis for the Fed here. All right, what's the benefit of them continuing to move so aggressively if the cost of those hikes puts undue and uncertainty on the economy in a world where inflation is moving in the right direction? And we have evidence, a lot of evidence. ISM prices paid, services prices paid, and the wage report from last Friday.
This man is moving all over the place. Chill out, man. Take a chill pill. Come on, man.
Tells us that inflation
man needs to go to the planet and do something. He's moving around way too much.
I think the Fed is close to wrapping it up.
We think they're close to wrapping it up. That goodness. And I'm going to convince you, Sarah, that they're not going to move by 450 basis points this year, right? So
do you think they're going to cut?
Yeah, you know, I hear a lot of these Wall Streeters talk like this, but it's like that's conventional wisdom. Like I don't think anybody thinks the Fed's going to keep raising and raising and raising. That would be the thing that shocks the market. And if you want to talk about a huge leg lower, like if the Fed just kept raising at 75 or 50 basis points of several times throughout this year, that would shock the market. That would cause another 10, 20% down for the S&P 500, something like that, if we had that sort of scenario, right? Another 10, 20% for the NASDAQ, if we had that sort of scenario. But no one's expecting that. I don't think the Fed's expecting to do anything like that. You would have to have another huge kind of tick up in inflation, which is going to be very hard to get that any sort of huge tick up in inflation anytime soon, nonetheless, right? Doesn't mean inflation can't come back a year from now or a few years from now, right? But in terms of this next 6 to 12 months, it's near impossible to get CPI because you would have to have everything get substantially more expensive now, and just commodities aren't acting in that sense whatsoever, right? And likely shouldn't. So, yeah, that's not like earth-shaking news in my opinion.
Cutting, we would need a real sharp pullback in the economy for that.
But you're not bullish on the Fed pausing, because you still think what, recession's not priced in, or
well, we think that the
weakness?
Fed pauses. Fixed income is a nice place to go. The dollar is important here. The dollar weakens, which introduces a whole bunch of asset classes outside of the U.S. And right now, we're long some calls on the S&P. Yes, we're underweight, but we're long calls on the S&P that can get us back into the S&P if that underweight is incorrect.
It did feel toward the end of last year that everyone and big funds and strategists were bearish this year. They're worried about the world falling apart because of all the Fed tightening and the fact that we haven't seen the recession yet, and the Fed is still hell bent on tightening. And it became a little consensus.
Yeah, but it was a race. It's always been a race between growth and inflation, right? So if we're getting evidence now, Sarah, that inflation is heading in the right direction. By the way, it's not going to be 2 anytime soon, but heading in the right direction. And tomorrow we get a CPI number that's likely going to seal the deal between 25 and 50
I don't know.
basis
Rodney
points.
McMullen didn't make me feel like food inflation is coming down anytime soon.
Yeah, but there's 3 pieces, right? It's goods inflation, definitely coming down. Everybody can afford a car again. And then you have the shelter inflation, and you talked about that.
Whoa.
Right? Shelter inflation.
Not
Whoa, whoa, whoa! Everybody can afford a car again. Excuse me, sir. What? No, that's not the way this works. That's not the way. It's not like cars have magically dropped off a cliff in terms of pricing or something like that. Cars are still very, very expensive. They just have moderated here recently. I think they probably have a lot more to go down over this next 6 to 12 months.
It's super fast either.
Owns equivalent rent looks lagged. I think the more anecdotal pieces of rents look like they're coming down. And then there's that part where wage inflation is so important. It's services X shelter,
Housing,
going to
yeah.
hotels, going to things like that, restaurants, and all that stuff. That's the part that we need to head in the right direction. In order to be really bearish here, Sarah, you have to have the view that the Fed's taken the policy rate to 6%. That is not priced in. That's a microcosm of where we were last year, and that puts a lot of pressure on the equity market. That is not our base case. That would be something that would keep us up at night, though.
Yeah, I don't think that's really the only way you can be bearish. I think the other way you can be bearish is believing that the Fed's gone too far and they're keeping rates too high for too long, and ultimately that will end up in a recessionary scenario, right? I think that's also another way, because, I mean, obviously if there's a recessionary scenario, and especially if it's any sort of vicious one, you're going to have earnings of companies fall substantially, which means valuations have to come down more in companies because their earnings just aren't there, right? So I think that's another way you could be bearish in this market outside of just thinking the Fed has to raise rates more or something like that. So anyways, guys, I appreciate you joining me as always. Thanks for being subscribed to the Reaction channel. I appreciate you all. Thank you everybody that supports on Patreon. If you're looking to do so, that's pinned comment down there. And tomorrow's the big day. Buy a new group of stocks in there. Appreciate y'all. Much love and have a great day.